You're watching Investing 101 by B&G Incorporated. Today, investment is mostly associated with financial instruments that allow individuals or businesses to raise and deploy capital to firms. These firms then rate that capital and use it for growth or profit-generating activities. While the universe of investments is a vast one, here are the most common types of investments. Stocks. A buyer of a company's stock becomes a fractional owner of that company. Owners of a company's stock are known as its shareholders and can participate in its growth and success through appreciation in the stock price and regular dividends paid out of the company's profits. Bonds. Bonds are debt obligations of entities, such as governments, municipalities, and corporations. Buying a bond implies that you hold a share of an entity's debt and are entitled to receive periodic interest payments and the return of the bond's face value when it matures. Funds. Funds are pooled instruments managed by investment managers that enable investors to invest in stocks, bonds, preferred shares, commodities, etc. Two of the most common types of funds are mutual funds and exchange-traded funds or ETFs. Mutual funds do not trade on an exchange and are valued at the end of the trading day. ETFs trade on stock exchanges and, like stocks, are valued constantly throughout the trading day. Mutual funds and ETFs can either passively track indices, such as the S&P 500 or the Dow Jones Industrial Average, or can be actively managed by fund managers. Investment trusts. Trusts are another type of pooled investment. Real estate investment trusts, REITs, are one of the most popular in this category. REITs invest in commercial or residential properties and pay regular distributions to their investors from the rental income received from these properties. REITs trade on stock exchanges and thus offer their investors the advantage of instant liquidity. Alternative investments. Alternative investments is a catch-all category that includes hedge funds and private equity. Hedge funds are so called because they can hedge their investment bets by going long and short on stocks and other investments. Private equity enables companies to raise capital without going public. Hedge funds and private equity were typically only available to affluent investors deemed accredited investors, who met certain income and net worth requirements. However, in recent years, alternative investments have been introduced in fund formats that are accessible to retail investors. Options and other derivatives. Derivatives are financial instruments that derive their value from another instrument, such as a stock or index. Options contracts are a popular derivative that gives the buyer the right but not the obligation to buy or sell a security at a fixed price within a specific time period. Derivatives usually employ leverage, making them a high-risk, high-reward proposition. Commodities. Commodities include metals, oil, grain, and animal products, as well as financial instruments and currencies. They can either be traded through commodity futures, which are agreements to buy or sell a specific quantity of a commodity at a specified price on a particular future date, or ETFs. Commodities can be used for hedging risk or for speculative purposes. Don't forget to like our videos, share them with your friends, subscribe to our YouTube channel and hit the bell icon to get notified whenever we post a new video. Thank you for watching Investing 101 by B&G Financing Incorporated.